Silver doesn't just move in price, it moves in rules. And yesterday, the CME quietly reminded you who writes those rules. Silver was trading around 91.30 when CME hit the kill switch. Trading stopped at 12:15 p.m. Central on Wednesday. For the next 100 minutes, every metals and natural gas futures market on CME was frozen. No buying, no selling, no stops, no entries, no price discovery. Just a hard pause with silver locked at 91. When the gates finally opened again around 1:45 p.m., silver didn't resume where it left off. It immediately dropped to around $88, a straight down $3 slam with no bounce, no hesitation, just a wall of selling that hit the tape all at once. Gold took a matching hit, down roughly $70 to around $2,164, and yet by the end of the session, silver clawed back to about 89.20, holding above the same resistance zone we've been talking about for weeks. That former ceiling is now acting as support. So if you just looked at the daily candle, you'd think normal volatility. But when you look at when the halt happened, what CME did to the order book, and what is going on in Comex inventories in Shanghai, the story changes. I'm not here to sell you a course or a signal group. I sell nothing. No memberships, no Discord, no special alerts. If you see my name in a paid group, that's a scam. The only places you'll find me are here on YouTube and on X. Data drops on X when it breaks. Full breakdowns are here. No paywall anywhere. If this sharpens the way you look at the tape, drop OG John AG or just OG in the comments so I know who's actually listening and who's just skimming thumbnails. Now let's break down what really happened and why the timing into settlement matters more than the official excuse. CME's technical issue, what actually happened. Here are the facts you can verify. CME halted all metals and natural gas futures Wednesday afternoon. Official explanation, technical issues. Natural gas futures reopened first, around 12:50 p.m. Central, about 35 minutes later. Metals stayed locked until about 1:45 p.m., roughly 90 minutes from the initial halt. That means for an hour and a half, silver was frozen at 91 while other markets moved. News continued. Algorithms continued to run in related assets, but you had no ability to adjust positions in metals. When CME brought metals back online, they did something subtle but critical. They canceled all day orders and all good till date orders that hadn't been fully acknowledged. Only good till canceled orders that had already been confirmed stayed in the book. Translation, your intraday limit orders, gone. Your protective stops, gone. Your staged entries, gone. The order book was effectively wiped clean and rebuilt from scratch at the reopen. Who benefits from that? Not the retail trader at work who finds out about the halt on a delay. Not the smaller fund that has to call its broker for a status update. It benefits the players who sit closest to the exchange, have direct lines and algos ready, can see the reset and repopulate the book in milliseconds. So when price reopened and instant selling knocked silver from 91 to 88, that was not some gentle price discovery. It was a brand new order book being hit with heavy coordinated sell volume into a vacuum. That's the structure. Now we ask the only honest question. Was this just a tech failure or something more than that? Two scenarios, accident or move. If you only ever collect evidence that fits what you already believe, you're not doing analysis, you're doing religion. So let's lay out both scenarios. Scenario 1, genuine technical failure. Exchanges are complex systems. Glitches happen. CME did have another technical issue in early February where settlement prices were delayed. So we've now had 2 disruptions in 3 weeks after roughly 5 years without major outages. Metals might legitimately require more checks than natgas before they flip trading back on. After a halt, it's normal to see stop-loss cascades and liquidation from levered players who panic or get margin called. Under this view, the $3 drop is just the market clearing out fragility that had built up around 91 or $92. If this is the whole story, then Wednesday's halt is annoying and suspiciously timed, but not deliberate. Scenario 2, strategic intervention, now the other side. This halt came 48 hours before March 1st notice day, with silver pushing into a major resistance zone around $92 that we've already identified in earlier videos. It is the second disruption in 3 weeks, after half a decade of nothing. Both disruptions clustered around settlement and momentum. When trading resumed, the selling was immediate, coordinated, and strong enough to slam price $3 lower in minutes. The forced cancellation of most resting orders reset the book in a way that systematically favors players with direct CME access over everyone else. Jesse Livermore wrote in Reminiscences of a Stock Operator that insiders with control of the mechanics of a market, the exchange rules, the halt switches, the margin calls, will always have an edge over outside speculators. When you control when trading is allowed, you don't have to move price directly with your own orders. You can simply choose when liquidity is removed and when it comes back and let the market's own structure do the rest. A well-timed halt can stop a breakout at the exact moment it's about to trigger cascading buy orders, clear bullish resting orders and stops, reopen into thin liquidity. so that comparatively small but concentrated selling looks like an organic collapse. Is that what happened here? We can't read anyone's mind, but we can look at the context around this halt, in inventories in Shanghai and open interest, and see if this pattern matches previous events. Comex inventories, 86 million ounces and falling. The most important number in this entire story is not $91 or $88. It's $86.3 million. That's approximately where Comex registered silver now sits. On Tuesday alone, registered silver fell by about 2.2 million ounces. Breakdown: 155,000 Oz withdrawn from Asahi vaults, 167,000 Oz adjusted out of Brinks registered, 647,000 Oz withdrawn from HSBC, 374,000 Oz taken from JP Morgan, 80,000 Oz withdrawn from StoneX. Some metal moved into Loomis registered, but even after that, net registered still dropped by roughly 890,000 ounces that day. Zoom out. Every day, registered inventory is declining. There is no meaningful new metal flowing into Comex vaults to offset what's leaving. Eligible inventory, metal in the system but not designated for delivery, still exists, but by definition it is not committed to back futures contracts. So you have a shrinking pool of deliverable silver heading straight into a major delivery month. Adrian for Heavy Metal Stats flagged that Tuesday's 71 million ounce roll out of March was the largest he's seen. Yes, that roll temporarily reduced March's immediate delivery risk, but it didn't fix the structural problem. Registered keeps falling while the open interest and the calendar march towards settlement. That's why this halt isn't happening in a vacuum. It's happening against a backdrop of tightening physical supply. Shanghai, 12 and 17 in premiums and a different reality. Now jump back to China. While CME was halting metals at $91 and reopening at $88, Shanghai was painting a completely different picture. Shanghai spot silver around $101. SHFE silver futures around $106. Western spot around $89. That's roughly a $12 premium for spot, roughly a $17 premium when you compare Shanghai futures to Western spot. That's not noise. That's Asia saying, we value physical silver in triple digits while your futures screen insists it's an 80-something asset. And this isn't a one-day spike. We've now had persistent double-digit Shanghai premiums on and off through January and February. When that premium doesn't close even after a Western price slam, it tells you something deeper than simple arbitrage is going on. You can't cleanly arbitrage that difference because China has export restrictions and licensing on silver. There are VAT complications and capital control frictions. So the premium becomes a signal, not a trade. It signals that physical demand in Asia is willing to pay far more than Western paper is admitting. Overlay that with a Western halt that just happens to hit as silver is about to test $92 resistance into a tight Comex inventory, and the pattern starts looking less like random noise and more like two systems diverging. Gold anomaly, 4,000 contracts that won't settle. Here's a piece almost nobody is talking about. February gold. The February gold contract is supposed to be near fully settled by this point in the month, yet data shows roughly 4,000 contracts still open. That's about 12 tons of gold, roughly $2 billion at current prices. By now, most of those contracts should either be delivered or rolled into a later month. Having that much paper still outstanding suggests someone has not delivered when they were expected to. Is that definitive proof of stress? No. But in context, shrinking silver inventories, repeated technical outages, widened Shanghai premiums, it looks like another small warning light on the dashboard. Gold and silver are different markets, but they share the same underlying plumbing, Comex vaults, CME infrastructure, the same clearing ecosystem. When gold starts showing late-month delivery weirdness at the same time silver is pushing inventory limits, you pay attention. Historical precedent, the November halt, and what followed. We've seen a pattern like this before. On November 28th, prior episode, CME halted silver trading for about 10 hours. Official reason, cooling issues. At the moment of that halt, silver was trading around $53.26. It was first notice day for the December contract. Reports circulated, including from alternative media and some institutional notes, that a Chinese industrialist had notified Comex of intent to take 30 million ounces of physical delivery. When trading resumed, silver spiked to around 56.78. Over the next 2 months, it proceeded to more than double, eventually hitting around $121. Was the halt itself bullish? No. The halt was a symptom. The underlying cause was intense delivery pressure, tight inventories, large buyers insisting on metal instead of rolling paper. When normal market mechanics couldn't absorb that pressure gracefully, extraordinary measures appeared. Cooling issues, halts, odd settlements. Once the market reopened, with that pressure still unresolved, the move accelerated. Now compare November, halt, first notice day, delivery pressure, big buyer rumored, price explosion after. Wednesday's halt, 48 hours before March settlement, declining registered stock, persistent Shanghai premium, and a $3 slam that temporarily relieved upside pressure. Different exact move, same timing pattern. The halt appears when delivery obligations and resistance levels intersect. Open interest rotation, futures out, SLV in another quiet shift. How people are choosing to get silver exposure. Data shows. Comex open interest in silver is declining. SLV, the big Western silver ETF, has seen new inflows. That rotation out of futures into ETFs is de-risk behavior. If you're worried about delivery risk, counterparty risk, exchange disruptions, you don't want to be holding the instrument that settles at Comex. You prefer something that trades like equity, settles through your broker, and doesn't expose you to a notice day delivery fight. Is SLV the same as physical? No. But to large funds, moving from Comex to ETF is still a message. We don't fully trust the futures plumbing right now, so we're stepping one level away from it. You don't abandon the purest leveraged vehicle unless you're worried about the pipes behind the price. Shanghai suspensions and Mexico, the deeper supply stress zoom out from CME, and you see two more key stress points. Shanghai Futures Exchange Enforcement. In February alone, SHFE has suspended or restricted about 25 trading groups for violating position limits in silver. We covered this in a previous breakdown. That is abnormal frequency for account suspensions in a single month. Exchanges don't do that when everything is calm. They do it when concentrated positioning is large enough to pose systemic risk, so CME, halts, and technical issues. SHFE, account suspensions, aggressive enforcement. Both major hubs are telling you there's enough pressure in this market to make exchanges nervous. Mexico, the largest producer under stress. Mexico is still the largest silver producer on Earth. Reports of escalating cartel-related violence, transport disruptions, and security concerns are increasing. That raises costs, complicates labor, and makes consistent output harder to maintain. Yes, there are efforts between the Trump administration and the Mexican government to stabilize mining regions, but on the ground, the supply risk is rising, not falling. Combine, structural global deficit, Mexico supply risk, emptying Comex vaults, Shanghai premiums, and then overlay CME halts at key technical levels right before settlement. That's your full picture. So, manipulation or coincidence? Here's the recap. Silver at $91.30. CME halts trading for roughly 100 minutes. Order book is cleared of most resting orders, trading resumes, and silver is slammed to $88 almost instantly. Gold drops about $70. Silver then recovers to about $89.20, holding above old resistance. At the same time, Shanghai spot 101 HARs, futures 106, Western spot 89s, a 12 to 17 premium that won't go away. Comex registered silver around 86.3 million ounces, down 2.2 million on Tuesday and falling daily. March settlement sits 48 hours ahead with a recent history of huge rolls and tight inventories. February gold still shows 4,000 open contracts, was 12 tons, late in the month. Second CME disruption in 3 weeks after half a decade of clean operation. Comex open interest declining while SLV sees inflows. SHFE suspending 25 trading groups in a single month. Mexico, the biggest producer, facing rising security and cost risks. You don't need to chant manipulation to see the pattern. You just need to acknowledge that market infrastructure is not neutral. When pressure builds, exchanges can halt. They can wipe orders. They can change margin. They can designate technical issues at the exact moment momentum is about to break their preferred levels. The halt is not the cause of the silver bull case. The underlying physical and structural tightness is. The halt is simply the moment the system flashes you a warning that it doesn't fully trust itself to handle the pressure in real time. How you use this. This is financial warfare education, not advice. I'm not telling you to go all in, and I'm not telling you to run away. What I am telling you is, pull the vault reports yourself. Check the Shanghai premium. Look at the February gold anomaly. Look at SHFE suspensions. Look at the Mexico situation. Then ask yourself, do you want to build your strategy around the comforting idea that every halt is random, or around the uncomfortable but testable reality that the silver market is running hotter than the infrastructure built to contain it? Most people won't check any of this because checking forces them to confront the possibility that the system is not as solid as they want it to be. They'd rather dismiss than verify. The minority, the ones who actually pull the reports and read the notices, they don't need convincing. They simply adjust. Invest with logic, not hype. Protect your capital. Respect the plumbing as much as you respect the chart. OG out.